Good evening, everyone, and thank you for joining us on Vaibhav Global's Q1 earnings conference call for the quarter ended June 30th, 2020. Today we have with us Mr. Sunil Agarwal, Managing Director, Mr. Vineet Khaneriwala, Group CFO, and Ms. Dipti Rajput, PGM, Investor Relations. We will begin the call with opening remarks by Mr. Sunil Agarwal on the business operations, key initiatives, and a broad outlook, followed by a discussion on the financial performance by Mr. Vineet Khaneriwala. Following the management's opening comments, we will open the forum for a Q&A. Before we get started, I would like to point out that some statements made or discussed on today's call may be forward-looking in nature and must be viewed in conjunction with the risks and uncertainties faced by the company. A detailed statement and explanation of these risks is included in the earnings presentation, which has been shared earlier. The company does not undertake to update the forward-looking statements publicly. I would now like to invite Mr. Sunil Agarwal to start proceedings on the call. Over to you, Sunil.
Thank you, Kyle. Good evening, everyone, and thank you for joining us today on Vaibhav Global Limited's Q1FY21 earnings conference call. I hope all of you, your colleagues, and near and dear ones are healthy and keeping safe. I would like to take you through key business highlights, give you an overview of the company's performance, and share my thoughts on the business going forward. We have started the current financial year with another exceptional performance in the first quarter. The headline numbers marked a considerable improvement year over year. Retail revenue improved 32%. EBITDA margin expanded 170 basis points to 14.1%, and profit after tax increased 47%. As this growth has been achieved on a largely stable balance sheet without any significant capital expenditure committed, we have seen strong improvement in return ratios and in free cash flow generation. Overall, we are highly encouraged by these numbers that reflect the success of some of the strategies we have executed over the last few years. In addition, Q1 performance has been delivered in what is normally a seasonally subdued period and in the backdrop of a widespread impact of COVID-19 pandemic. Our performance showcases the inherent strengths of the business model. Over the years, we have emphasized on qualities such as inclusion and agility, which have helped navigate through the dynamic operating, technological, and competitive environment. Towards the end of fourth quarter of FY20, we saw nervousness in the markets, and we responded with agility. In addition to our regular fashion jewelry and lifestyle products, we quickly offered health supplements, kitchen appliances, home cleaning products, masks, sanitizers, and the likes to our audience. This resulted in significant volume increase to 3.2 million pieces from 2.3 million in Q1 last year, a 39% increase. This also resulted in addition of 84,000 new customers compared to 28,000 in Q1 of last year. On trailing 12-month basis, we served 426,000 unique customers in Q1 FY21 compared to 347,000 in Q1 last year, an increase of 23%. The ties that we have deepened with our existing customers and developed with new ones that we have built, will have a long-term impact on the business growth. We see this momentum continue to take us forward in the foreseeable future, allowing us to achieve standout operating and financial performance reflected in revenue growth and improved profitability. Till date, the lockdowns enforced in any geography have not disrupted our business activities. Our retail operations at Shoppers US and TJC UK witnessed robust business growth with revenues up by 20% and 32% respectively in local currencies. Our global supply chain network includes manufacturing setups in India and China and direct sourcing from micro markets in more than 20 countries. When China and India were in respective lockdowns, other countries picked up the slack and kept retail operations adequately stocked. This diverse and wide locally staffed sourcing footprint has helped us serve our customers at elevated demand levels and continue to offer a wide range of products, with turnaround in product offerings and gross margins around the target level of 60%. Our team is our priority, and we have taken appropriate precautionary measures to ensure safety and health of all during this period of pandemic while continuing business operations. We paid extra compensation to our frontline workers and studio staff, warehouse workers during the lockdown period. Staff that are not really needed to be on site are continuing to work from home even now. We are carrying out numerous initiatives to help our team members engaged and informed during this pandemic. We have not retrenched or furloughed any of our employees in any location due to COVID-19. Here I would like to share some key initiatives undertaken during the quarter that will drive future growth as well. At Shop TJC UK, Pixely, a user-generated content and influencer marketing platform, was integrated into TJC UK website. To strengthen our social marketing program, we engaged with TV Page platform that enables online ambassadors. We started simulcast on one of our most popular channels in UK called More4. At Shop US, home shopping celebrity Chuck Clemency, who has been in the industry for over 27 years, joined us as an expert guest host. At our warehouse, we streamlined our workstations and added automated conveyors. We have also invested in onboarding expert talent for expediting growth on emerging platforms. We continue to focus on our strategic objectives of expanding the 4 R's underlying business performance. That is, widening reach, growing new customer registrations, improving customer retention, and increasing repeat purchases. At the end of Q1, the reach of our TV network stood at 100 million TV homes compared to 99.4 million in the same period last year. We are strengthening our presence on our omni-channel sales platforms, which include proprietary TV and web platforms, social media, OTT, and marketplaces. An omni-channel customer has a significant higher lifetime value as compared to a single channel customer. New registrations in the quarter jumped to 96,000 from 36,000 same quarter last year. Our repeat rate, defined as average annualized quantity purchased by each customer on trailing 12-month basis, stood at 27.2 pieces per customer compared to 30.5 customers last year. This is down due to substantially high new customer acquisition achieved this quarter. Customer retention rate stands at 50.5% from 50.2% in Q1 of last year, improving steadily. Now we talk about some of the achievements. I'm happy to announce that Shop US received Governance Achievement Level recognition from Quality Texas Foundation for ongoing quality improvement and high performance. This recognition indicates a well-deployed, effective, systematic approach to organizational management with good performance levels and trends evaluated against industry standards. In other notable achievement, Shop TJC UK has been recognized amongst UK's best workplaces and best workplaces for women by Great Places to Work Institute. As the world continues to reel under impact of COVID-19, we continue to show our solidarity with frontline medical and law enforcement teams who have been working tirelessly for the last 5 months now. We donated over 160,000 masks across hospitals, care homes, police stations, and grocery stores in the US, the UK, and India. In these challenging times, we've provided approximately 3.4 million meals to people in need through Akshay Patra, India. Coming to our flagship CSR initiative, the 1 for 1 program, we crossed a huge milestone during the quarter and have now provided over 40 million nutritious meals to school children across India, US, and the UK since the program's inception 5 years ago in UK and 3 years ago in the US. Before I conclude my opening comments, I would like to restate that Vaibhav Global Limited continues to drive agility and inclusion across every aspect of its business. This is resulting in sustained financial delivery that is visible in our ongoing retail revenue growth, operating margin expansion, growing earning per share, and rising return on capital employed and cash flows. We expect the momentum to continue this year as well, and we look forward to improving value for all our stakeholders. In the short term, our revenue growth will continue to be at elevated levels owing to customer propensity to online shopping during current pandemic. The elevated growth may continue in the medium term as well. However, I would like to reiterate that we are favorably positioned to deliver 15 to 17% retail revenue growth on constant currency terms. And you may already be aware that the business model has inherent advantages of significant operating leverages. To conclude, I would like to express my sincere gratitude to VGL team who make the magic happen. Thank our vendors for their continued support and our community partners who give us a meaning to what we do every day. With that, I now hand over the forum to Vinny to discuss financial performance for the period under review. Over to you, Vinny.
Thank you, Sunil. Good evening, everyone, and welcome to Vaibhav Global Limited's Q1FY21 earnings call. I hope that all of you and your families are safe and healthy. I'll take you all through our financial performance for the quarter ended 30th June 2020. We witnessed a good start to FY21 with both geographies recording strong performances during the first quarter. Our revenues increased by a strong 25% year-on-year to rupees 550 crores. Gross margin came in at 64.3%, even as we expanded our portfolio of products to essential items. We have continued to see increasing sales contribution from fashion accessories, lifestyle, essential products in our overall product mix. We have maintained target gross margins of around 60% over the last several years while sustaining our deep value offerings across a growing number of product categories. Margins are also supported by our ability to source from micro market at lower cost and a quicker turnaround time compared to our competitors. Q1 FY21 EBITDA margin expanded by 170 basis points year-on-year to 14.1%, and profit after tax grew by 47% year-on-year to rupees 53 crore. As we expand revenues on a stable operating cost base, operating leverage continues to play out, and this trend may continue during the rest of the year as well, based on the growth visibility for the business. Earning per share increased from rupees 11.02 for Q1 FY20 to rupees 16.37 for Q1 FY21, driven by growth in profits. These financial numbers indicate a positive trend and a strong traction for our product offering among customers. Even more so in the extremely challenging circumstances several businesses across the globe are finding themselves in. As you all probably know, we have been focusing on the retail B2C business, which constituted almost 99% of our total revenues in Q1 FY21. We have been early adopters of the omni-channel sales model. We continue to expand the engagement with our customers through multiple platforms we operate on, such as television, web, mobile apps, marketplaces, social media platforms, and several new age digital platforms. This adds to our strength and gives us the flexibility of cross-referencing customers, which is beneficial to business growth. While headline revenue grew at 25% on a year-on-year basis, B2C revenue from omni-channel platforms were up by 32% year-on-year. Within retail B2C, the TV home shopping based revenue were higher by 25% year-on-year, and revenues from web platforms grew 47% year-on-year. Web is now contributing 37% of retail B2C sales in Q1FY21, up from 33% in Q1FY20, as revenues continued to get more balanced between the two sales channels. While we continue to report these numbers separately, it is important to note that the two platforms are continuously converging to form a symbiotic omni-channel ecosystem, along with several other emerging sales channels that I just mentioned. Volumes in both TV and web were strong, showing year-on-year growth of 39% and 40% respectively. ASPs were lower on year-on-year basis due to transition in the sales mix based on the larger range of offerings. In addition, we see our platforms increasing becoming product agnostic. The contribution from non-jewelry mix to retail revenues has been expanding, and it now stands at 36% as compared to 18% in Q1 last year. Growth in both the geographies have been robust. On a constant currency basis, Shop LC US grew by 20% year-on-year, while TJC UK grew by 32% year-on-year for the quarter. We reported healthy cash flows for the quarter. Operating cash flows for the quarter stood at rupees 87 crore and free cash flow came in at rupees 82 crore. Return on equity was 26%, while ROCE improved to 49%. The uniqueness of our business model supports high cash accretion on a low asset base and low Kpix requirement for a significant scale-up. Combined with a negative net debt position, results in a higher ROCE on a consistent basis. We have put in place our dividend distribution policy, based on which VGL would now endeavor to maintain a total dividend payout ratio in the range of 20% to 30% of annual consolidated free cash flow of the company. Based on the same, the Board of Directors declared an interim dividend of rupees 5 per equity share for Q1. To conclude, we have witnessed another quarter of strong growth, especially in this challenging scenario the world finds itself in. This has been possible due to our agile business model, which has helped us consistently to adapt to change. Cost consciousness is firmly embedded in the company's culture. In current time, we have renewed our focus on cost rationalization and cost rebasing by renegotiating all contracts. We maintain a strong balance sheet that allows us to reward shareholders while evaluating any new growth opportunities. Going forward, we expect to maintain our growth momentum to add further value to every stakeholder associated with the company. With that, I conclude my opening remarks and request the operator to open the forum for questions.
Thank you very much. Ladies and gentlemen, we will now begin the question-answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Pritesh Chheda from Lucky Investment. Please go ahead.
Thank you for the opportunity. Sir, at this juncture, do you want to call out for a sustainably higher growth rate on a constant currency basis for us in FY21 and also a much higher growth rate on a sustainable basis from here on versus the 12 to 15% growth rate that we were earlier calling out on constant currency?
Hello, Pritesh. This is Sunil.
Hello, sir.
Thanks for your question. So, first of all, our earlier growth rate guidance has been 15 to 17% for last, I think, couple of years. So, the current pandemic environment is something unknown for us, although we've responded very in an agile manner, and we've also acquired a lot of customers. But there are still a lot of unknowns. We may continue at higher levels, but at this time we are continuing our guidance of 15 to 17%, mainly because there are a lot of unknowns.
Okay. Any supply side challenges that you are incurring, or any challenges for the 15 to 17% growth rate generation?
Not at all. No
Okay.
From supply side.
Okay. And thirdly, third question is, sir, on the US operations, what would have been the market growth rate in the TVC business there? And any market share changes that you would have seen in the quarter gone by, if you have some educated guess there? And from the initial commentary, you mentioned that the platform has become product agnostic. So in a latter stage, someday the TJC, which is the Jewelry Channel UK, also eventually have to be repositioned at some latter date into a different name to accommodate the product agnostic platform?
Sure, Pritesh. There are two questions. One is about market share and about the naming of TJC UK.
Yeah.
So market share wise, in 3 years, this is the data that we recently looked at. So we increased our market share from 1.5% to 3%. But we have a long runway in front of us. I'm looking at only television/e-com players. We do take market share away from other brick and mortar as well, but I'm not counting that. So we have a lot of runway in front of us, from 3% up to the industry leader in front of us. Now, second point is about the TJC UK. So TJC UK is already product agnostic because it used to be the Jewelry Channel. So we renamed it TJC about 4 years ago. And since then, it has been product agnostic, and we don't need to change it for the name, for the product sake.
So now it is known as just TJC. It's not known as the Jewelry Channel, nothing of that sort.
Correct.
Okay. Thank you very much, sir, and all the best to you. Thank you very much.
Thanks, Pritesh.
Thank you. We take the next question from the line of Lakshmi Narayanan from ICICI Mutual Fund. Please go ahead.
Thank you. Couple of questions. First is, over the last 4-5 years, how the demographic of your customers in both in US and UK have changed in terms of age as well as any other income patterns? That's the first question. The second question is that from a fulfillment rate of your assortment, how the efficiency has actually improved in the last 4-5 years. And the third question is that if you look at the product placement either via TV channels and also various other things like Amazon, Google Marketplace, etc., what's the kind of margin difference that actually happens between television and the other channels?
Sure. So the first question is about customer demographics. So on the television space, the customer age group is same. It hasn't changed because people who stay at home or people who are retired spend more time on television. But with our switch more and more towards digital and social, our average age has come down a bit. I don't have exact data right now with me, but we are seeing, in fact, we just discussed last board meeting only. We presented what is the age group. So we are seeing more 20s, 30s age group showing up as a ratio of total customer group. Second question about fulfillment. We have added automation in our warehouses over last year, and that has improved our picking and packing productivity. But our productivity compared to Amazon is still about 1/3. So they are 3 times more efficient than our warehouses are. And that is our future growth path or the cost reduction path. As we go into the new warehouses, automated warehouses that are in the plants, we will improve our efficiencies substantially. Your third question was about...
So on that front, where are the warehouses right now, and where are we planning to add any warehouses?
So within US and UK only, so we are continuing to add automation within our warehouses. And as we run out of our capacity, so we are planning 3 years out. So as we run out of capacity, as we see running out of capacities, we will add warehouses locally. And over the longer term, we will add warehouses in different locations. Especially in US, we will be adding warehouses in East Coast and West Coast. Right now, we are located in South Central location of US. So to get closer to the customer and faster to the customer, we will be adding warehouses locally. But that is still in early stages of planning. No concrete location or Kpix plan from that yet. Mm-hmm. The third question was about product placement at the marketplaces and other properties, how the gross margin differs. So our gross margin is identical at marketplaces as well as our own digital properties. Because the same feed that goes on our platform goes automatically on marketplaces like Amazon, Walmart, Wish, eBay, Overstock, and Google. So all those marketplaces have automatic feed. So it's not manual feed. And so the gross margin is very similar because the product is same.
Mm-hmm. So but if you'll be paying some placement fee, etc. in these platforms. So on the margin at your end, what is the difference? Not at the gross margin, but on the after deducting the expenses.
So I don't have exact data, but yes, you're right. We pay placement fee, the sales fee, and also some advertising fee on those platforms. I don't have exact profitability numbers in front of me for each segment, but we know that each segment...
Trying to understand because I'm just trying to understand if you kind of put all the costs together for television, and then if you put cost for this, right? So at the operating margin level, what delta it actually is, because as the mix is changing towards more of non-television, so is it good or bad for the organizations as we move forward for the next 5 years? That's the reason for this question.
Yeah, so as I mentioned in my opening remarks, our business is pretty much omni-channel, and we try to move customers extensively into different channels because their lifetime value goes up by at least 5 times if we do that. So our interest is to move people from social to our digital properties, from social to even marketplaces, and from marketplaces to our digital properties, and if possible to television as well, because that's where the lift to the business comes in. Now, when we look at standalone basis, all properties, whether it is marketplace or digital or television or even social now, they are all profitable for us, standalone basis. But our main benefit comes when we move customers from one channel to other.
Sir, on the first one, on the demography, right? What is the average age right now for our customers in US, and what is it in the UK?
I don't have the exact average age, but our customer demography used to be from 35 to 75. Now is about 25 to 75.
Got it. Okay. And is it skewed towards the above 50s or any idea on that?
So television is skewed towards older age. Digital is a little lower. Marketplace is even lower, and social is the lowest.
Okay. Thank you so much. I'll come back in queue.
Thank you, Mr. Lakshman.
Thank you. We take the next question from the line of Chintan Seth from Sameeksha Capital. Please go ahead.
Thank you for the opportunity. Am I audible?
Yes, you are.
Yes, sir. I have one set of questions. So, if you look at our growth, TV compared to web is growing faster. So, past 3-5 years. And within TV, my understanding is that we have roughly 2 TV channels, each in US and UK, through which we broadcast our products. So my first question is, can we sustain our rate of revenue growth in TV from the existing broadcasting space? And if we aim to grow much faster than that, whether we need to, add channel count or broadcasting space per se to grow TV side of the business. And related to that, since our web sales growth has been stronger than our TV sales, I understand our omni-channel model, where a lot of our efforts on TV front is driving web sales as well. So in that context, how do we see your incremental investments in TV and web over the medium term in terms of building the platform or building the broadcasting space in either medium?
Sure. Thanks, Chintan, for your questions. So TV revenue growth will continue for quite visible foreseeable future. The reason is that we still are not into the prime channel positions that our competitors are. So as I mentioned in my opening remarks, we just contracted with More4 in UK. And similarly in US, we are going to experiment with those prime channel positions. They are more expensive. So we are experimenting with small markets and see how those markets pan for us. In UK, it has been doing well for us. So when you look at QVC or HSN, their revenues are from $25 to $60 per home. Our revenue is just around $3 per home. So from TV space also, we see a lot of potential for many years to come. From web sales, that as you see, the ratio of our sales in web continues to grow up because web has more potential, and we are continuing to invest in web platforms on native web as well as web-related properties like OTT, which is smart television, and also social media, and the other marketplaces that is web-based. And those are seeing much higher growth than our own digital as well as television.
So incremental investments, given the growth, will still look lower because our efforts in the digital and web and social side will continue to grow the business, while even if we go for a higher cost prime time channel space, it kind of offsets the overall trend in terms of broadcasting cost. That's the way we should look at it?
Yes, you'll continue to see leverage because we are more measured in our approach as a business. So there'll be leverage into free cash flows as well as into operating profits.
Sure. Okay, so incremental greenfield channel or incremental additional channel, even though it will be cost will be front loaded, you believe that can be offset by the increase in the growth from the other mediums?
That is correct, and we have a very rigorous method of evaluating any new opportunity. So any new channel we take, we have evaluation methods of 1 month, 3 months, 6 months, 1 year, and 15 months. And at every level, they must meet certain criteria. Otherwise, we exit that market with a lot of agility. So I don't believe such kind of agility is normal for this industry.
So if I need to ask cumulative, how many hours of broadcasting content we display through our TV on a daily basis in terms of hours?
24/7 live. I think. So we are live 24/7. So so that many minutes a day. Now, how many channels that we broadcast on? Currently, it is less than 2 channels per home. I don't have a exact number, but it is less than 2 channels. I mean, QVC is about 3.5 to 4 channels per home. So we have a lot of room to go from that point of view.
Correct. Okay, sir. Thank you. I'll join back. Thank you. That's it.
Sure, Chintan.
Thank you. We take the next question from the line of Ashish Kacholia from Lucky Investment. Please go ahead.
Yeah, good evening, sir, and congratulations on a great set of numbers. My question basically, sir, can you just talk a little bit about what is our strategy and the kind of traction that we are seeing on the Instagram platform. I see your web page on Instagram, and it's quite interesting with a lot of following. So if you can just talk a little bit about that.
So earlier we used to just advertise on Instagram, but since last about 4 months, we've started to present the product through the videos and through still images on Instagram. And that is gaining a lot of traction. So we're getting revenue directly from that as well as following. And we'll continue to accelerate that method of promotion. It's called social DR, social direct response. And we're standing up a very robust team to take advantage of that.
Okay. And, so what are the kind of investments or what are the kind of, percentage of sales that you hope to do in this platform over the next 2, 3, 5 years, whatever?
Still very new. So to give a projection on that would be, we have our internal projection, but to state a projection to a wider community may be too early. But we are setting up a team of about 8 to 10 people between US and UK and India, and accelerate that business.
Okay. And on Facebook, do we have a similar kind of a commerce channel on Facebook as well?
Exactly. So same feed goes both Facebook and Instagram.
Okay. Right, sir. Right, sir. Thank you very much and all the very best.
Thank you, Ashish. We are very excited with that future growth potential in that space.
Yeah, it looks very interesting because, I see a lot of, women commenting, oh, this looks so good and this looks, so nice. And, it seems to be quite a buzzing kind of a channel. So, that's kind of pretty interesting.
It is.
Ultimately, I think it's a question of how big a community can we create. I think this is a real classic case of success building on itself. So if we get this right, I think it can just completely change the fortunes of our company.
That is true. And actually, what we've done is we're standing up a very strong innovation team, product innovation team as well, because social is all about innovative products. Although we were innovating earlier very much, but we were more trend spotter earlier. So we're standing up an innovation team who can come up with solution product that customer or the people or innovators want, or something they are outstanding in the market. And that will play into these particular channels. And we are very excited with the whole ecosystem that we are creating.
My thought would be that, suppose we were to be the Zara of this space, the fast follower model, So you have a lot of these very expensive designs that come out on Harry Winston or, all these very expensive jewelers, right? But the consumer aspiration is such that they want those same jewelry, but they want it, at $30. Yeah. So if you can deliver a $30,000 piece at $30, then that's like an insane value. So do you feel that we can do something like this?
So the Zara model we've been following up for many years, Ashish. Our idea is to go one step further also for social channels, to come up with a solution product that people is not out there. Looking at the problems that people face, for example, customers might be wishing for certain solution in their lives, and they can't find a product for that. So we want to be able to address that need in addition to what is already out there, but cheaper.
Yeah. Great, sir. Thank you very much. Your thought process seems to be on the right track, and I just hope we can really execute on this. I would just say that, sir, we should not underinvest in this. I mean, this is some, if need be, instead of 10 people, if you feel that there's more potential, then maybe 20 people, 30 people. I mean, as much as this part of the business needs, I think that kind of investment we should give it because we have the cash flows now to do that.
Of course. Thank you for the advice. Please keep that in mind.
Great, sir. Thank you so much. All the best.
Thanks.
Thank you. We take the next question from the line of Akash Singhania from Motilal Oswal Mutual Fund. Please go ahead.
Good evening, sir, and congratulations on the great set of results. I have two questions. Yeah. First one is, we have seen a lot of new customers, the first-time customers this quarter. So I wanted to understand whether these new first-time customers are as profitable as repeat customers, or there has been any cost of acquisition like discounts, rebates, or incentives to any of the new customers.
Okay. You had another question, or should I answer this?
And the second question is, in the non-jewelry sales, which has now almost doubled this quarter, on a YOY basis, almost from 18% to, I would say, 34-36%. So can you tell what are the trends you are seeing in terms of, I would say, retention of these and cross-sell for these customers from our jewelry part? So these are my two questions.
Thanks for your question, Akash. So from the new customer's point of view, the cost of acquisition is not anything meaningful extra. We do some incentives on social or from marketplaces to transition to our main channel, but they are not really meaningful. So these new customers came mainly because of the product offering and the engagement that we had during this time. Because during pandemic, other retailers, the brick and mortar were closed and people didn't want to go out. So shopping online and on television was predominant. So no, we did not spend much time and much money in acquisition of these customers. Our opportunity is to engage these customers and have their repeat purchase rate similar to what our historical customers have shown. So that we have a waterfall methodology drafted in both channels, US and UK, to utilize these customers, to engage these customers to outside product, say jewelry product or the other home product or accessories product. They might have bought some essential, they might have bought home product, they might have bought jewelry during this time, how to engage them further. So that continues to be our opportunity and our task. And that is why we are not giving a firm elevated guidance at this time, because we don't know how much we can engage these customers. We hope to do so, because we are seeing in current quarter, our sales growth is continuing to be at a higher level, even though the essential product has gone down substantially. So we are seeing that right now, but how long it will continue, we don't know. The second question was about non-jewelry sales, cross-selling those customers other products. So this would also be pretty much similar answer to the first one. So we have a waterfall systems in place with about more than 10 tactics to engage those customers into different way, through discounts, through offerings, through catalog, through calling, all those methods. And we are continuing to do that, and we are seeing some traction on that, but it is still too early to say how much we will be able to transition those customers into other business.
Thank you so much, sir. I wish you all the best.
Thank you, Akash.
Thank you. We take the next question from the line of Pulkit Singhal from Motilal Oswal Asset Management. Please go ahead.
Yeah, thank you, sir, and congrats on a good set of numbers. Just wanted to further check on this 32% kind of revenue growth momentum. Is it fair to say that April may have been a bit impacted, but I mean, the way we are looking at in June, the recent trends, June, July, they are working at a higher level than this average?
So 32% revenue growth was for the whole quarter. April, initially, couple of weeks were slow, but after that, it really picked up for the whole quarter. And we are seeing Q1 type of revenue growth currently in July, but how long it will continue, we don't know. It is still very early in Q2, but how long it will continue, we don't know. So that's why we are not giving any elevated guidance at this time.
Okay. And to that extent, that product mix could reverse as well. I mean, it is possible that jewelry, non-jewelry.
Yeah, product mix has already changed from Q1 to Q2. Q1, we had approximately 17% essentials. Right now, the trend we are seeing right now is only about 7% essentials, even less than 7%. But still, the sales is at the elevated level. So we are continuing to offer product for what they need. So jewelry sales is again resumed to be at a higher level, and other kitchen product is continuing to sell well. In jewelry, earrings are selling well because a lot of people are on Zoom calls, or the tops are selling better than, say, bottoms or skirts. So we are moving very with an agile method with whatever customer is needing.
Okay. And what percentage of the web sales of $203 million do we have from other platforms versus our own platform?
Because I don't have that exact data right now, but maybe Deepti can share that later with you.
Sure. And
I can only tell you about the marketplace that I remember. The marketplace was about for last quarter. I don't have exact data. For the whole year, last year was about $4 million approximately marketplace, and this year's current revenue trend is about $12 million, $10 to $12 million. So that is the only data I have visible to me.
10 to 12 this year or this quarter?
Mm-hmm. This quarter is the run rate of about $10 to $12 million for the whole year. So
for the
run rate.
Okay.
So last year we did about $4 million in marketplaces. Okay. So this year is about 3 times higher. So what it tells me is that even when we are selling on marketplaces like Amazon, Walmart, eBay, it shows our product strength because we are competing there with millions of vendors. So our product strength is robust. So we are able to grow 250-300% in marketplaces in competition to other players. So that gives us confidence in the product.
Oh, great. And so in terms of the costs that we've seen this quarter, whether it be in terms of employee costs and other expenses, they've grown 20% and 26%. I'm just wondering whether there are some one-off elements this quarter because of the COVID situation. There are higher costs. Is there something that you would like to call out, or do you think these are the more sustainable run rate as you're investing in the business?
Vineet, you want to answer that?
Yeah, I'll take that, Sunil. So yes, we have some COVID cost, as we may call it, because like Sunil mentioned in his opening remark, we paid higher salaries to our warehouse staffs and studio production teams who operated in this COVID pandemic from the site. So altogether, if we remove that extra COVID cost which we paid during Q1, and also there is some forex translation coming into play because the average rate being higher for Q1 this year. If we remove both of these, the employee cost would be increasing at a rate of about 8 to 9% year on year, which is pretty much what we expected it to be.
Right. And that would reverse by Q2 or that will continue as you continue to have elevated costs because of COVID?
So the COVID cost of 4 to 5% will reverse from Q2, but the forex translation would depend on the prevailing rates.
Yeah. Okay. And lastly, what is the Kpix plan for the year?
So right now, last year we incurred about 35 crore of Kpix. So our run rate Kpix is pretty much similar, unless, like Sunil was mentioning, we go ahead and invest in some of the warehouse or the office premises, which will come on as we see a viable project for that. Other than that, the run rate Kpix is close to 30 crore for the year.
All right. Great, sir. Thank you and all the best. These are exciting times. I hope you continue to do as well.
Thank you.
Thank you, Pulkit.
Thank you. We take the next question from the line of Lakshmi Narayanan from ICICI Mutual Fund. Please go ahead.
If you look at your sales returns, what is usually your sales return, and how you're handling that logistics issue given COVID? That's one. And second, in terms of the non-jewelry items, when you then sell something like hand torches, etc., right? So how do you manage that SKU mix, and what is the proportion of that in our sales, and what growth it is actually seeing, and how do you plan to grow that particular non-jewelry item in your portfolio of products?
So, thank you, Mr. Lakshmi Narayan. So sales return is a normal part of business in our case. So we have approximately last quarter, or we saw similar. So last quarter of financial year 20, we saw elevated returns because people got nervous. But in first quarter, Q1FY21, that is our normal return rate, which is approximately 18.6%. But we have a team in our warehouses that handle the returns, and like any other warehouse people, they were there as well. And we paid extra during the COVID times, and they were there, and they still are there. So our returns up. In fact, it used to be about 2 days backlog, but right now we have not even 2 days backlog. We are refunding to people same day of the thought reaching us to make them comfortable.
And this, I'm sorry to interrupt. So this 18% return is something which has been there for the last 3-4 years, or it's been, and how do you handle that returns? Once the return happens, do you kind of refurbish it and send it to the place of origin? How do you handle that part also?
So some portion of return, very small portion of the return, if it is, say, if we sold wigs to the people, and if it comes the seal broken, then we don't sell it back. Or say if there's a lingerie we sold, we don't use it back. We put it into trash. But most of the product, for example, jewelry, we inspect it for quality. If it is the right quality, we put it back. If it is earrings, then we steam it, sanitize it, and then we put it back. If it is other household product, if it is usable, then we put it back. So very small portion of that is discarded. Since most of our product is sourced from Asia, we don't send back to Asia. If they're small run products, which doesn't go on air, we put it on our rising auction or clearance section. Rising auction is a mechanism of starting everything at $1, and at whatever price it clears, it clears. So we have very good mechanism of exiting the small tails or returns. So we don't have accumulation of inventory, as you would have seen our cash flows. Because of we don't accumulate inventory of small tails, we have a good mechanism, so we don't accumulate. Your next question was about a non-jewelry product, how the mix is changing. So as you might have seen, our non-jewelry product has steadily increased as a ratio of total sales. And we expect that to continue, because as we are learning more about the product, as we are learning about customer taste, as our merchandising, our sourcing is getting better, that ratio will continue to steadily increase. Although within this quarter, it increased suddenly because of essentials. But in long run, we see that continuing to steadily increase over the time. And we are also learning, for example, the fabric. Kaftans is receiving great traction. So we just started a factory in Kaftan in Jaipur. So it's a contract factory that started last month only. So as we see traction and volume increasing for us in certain category, we'll go deeper into it, into manufacturing or contract manufacturing or our own manufacturing. So we'll continue to go deeper and retain our value proposition for customer and capture the channel margins as much as we can.
And what is the mix now? Jewelry, non-jewelry, I missed that part, sir.
Hello, can you share that number?
Okay, so yeah, Sunil. So the non-jewelry is right now 36%, and jewelry is 64% for this quarter.
And would it be in terms of your arrived operating profit margin, how that mix would be approximately? Would be similar, or it could be the other way around?
So the operating margin or the yeah. So Vineet, go ahead.
So we have quite similar margins across the different product categories, and maintaining the gross margin above 60% is one of the basic rule we follow for the product to find a space in our TV or web. Sunil, if you want to add anything.
That is precisely correct. So we start with our gross margin. So whenever a merchants a product, merchandises a product, or whenever our India, China, Thailand, or whichever our local units offer a product to channel buyers, they keep the margin in mind. So we have that rule that we won't sell any product below certain margin. So we start from that. And if the product doesn't make those criteria, it doesn't get picked up. So it doesn't go from product to margin, but from margin to product.
Got it. Very helpful. Thank you so much.
Thank you, Mr. Lakshminarayan.
Thank you. We take the next question from the line of VP Rajesh from Banyan Capital. Please go ahead.
Yeah, thanks for the opportunity. My first question was regarding the new customers that have come on the platform. Can you just comment of what is the driver for that?
So two drivers. The main driver is that people were staying more indoors and brick and mortar retail was not as prevalent. And second thing is, and combined with that, our essential and home product offering that we sourced very quickly and offered. And the second is that we are more and more we are transitioning customers from different sales channels, for example, marketplaces. As I mentioned earlier, we are seeing sales triple from those areas, and we are transitioning those customers to the main business. From social DR, we are transitioning to the main business. From OTT, there is streaming platforms. We are going aggressively into marketing to those customers and transitioning those customers to the main business.
Okay. So, most of the people in these markets, especially in the US, they had these payments given to them for unemployment, $600 or something. So do you think your sales were impacted because of that kind of stimulus, or do you think this kind of customers coming on board are sort of sustainable and will stay with us for a longer period?
So stimulus might have helped them sustain their normal buying behavior, which may not have if this money had not come. But we don't believe that this money has actually highly elevated our sales, the sales or the customer acquisition. That was mainly the result of us offering them the right product at the right time and elevated viewing or online shopping.
And my second question is, could you share, the customer acquisition costs, especially on Insta or Facebook that you were earlier talking about?
I don't have exact data on that, Mr. Rajesh. Everything is baked into on our P&L. From television properties and from our digital properties, all our marketing costs are not really high. It is we are relying more and more on the product strength and the product stories that catch people's eyes. From Insta and from my memory from Insta and Facebook, our platform costs are approximately 30 to 40% of our sales currently. That is the cost that we pay to them. So if we have 60% margin, that is easily affordable by us.
60% is excluding your marketing costs and cost of goods.
Correct. So no. Yeah. So outside cost of goods, our gross margin is 60%, or 64% in last quarter. Of that 60%, we are spending about 30 to 40% into platform cost. That is Insta and Facebook, but they're still very small revenue for us at this time. So they don't really count into our overall mix. Now from the platforms of marketplaces, that is Amazon, Walmart, eBay, Overstock, Google, our platform cost is approximately 30 to 35%. There is a fee we pay to the platform and the marketing we do within those platforms.
Right. Okay. That's very helpful. And the other question I have is that what is your repeat customer count, meaning what percentage of customers are repeat in this quarter where they have bought it in the past and they're coming directly to you?
We look at repeat in terms of how many pieces that they bought from us on an average over last period. And we look at trailing 12-month numbers. So as I mentioned, it was so repeat purchase about 27 compared to 30 last year. And the second thing we look at retention. How many customers that purchased year before purchased in last 12 months? That number is 50.5% compared to 50.2% of corresponding period year before.
Great. Thank you very much.
Thank you, Mr. Rajesh.
Thank you. We take the next question from the line of Sabyasachi Mukherjee from Centrum PMS. Please go ahead.
Yeah, hi. Thanks for the opportunity. First of all, congratulations on a great set of numbers. I had two questions. First, you mentioned that you are witnessing elevated revenue growth for the current quarter as well. What's your outlook in H2 of current financial year, given that US elections are scheduled? If you can throw some light on that.
So we may see elevated growth continue if the habits or the behavior continues. If people stay indoors, we'll see elevated growth continue. If the elevated growth does not continue, if you find vaccine, if people are able to travel very openly as they were using to travel before, we will go back to 15 to 17% growth. Now, how much of the new customer that we acquired during pandemic, how many we can transition to the H2, we do not know yet. So that is why we are not giving higher guidance at this time.
Okay. Second question actually, had two parts. So I was going through your annual report. First of all, that if I look at your other expenses, between FY19 and FY20, the absolute value remained same. I mean, 670 crores odd of other expenses. Hardly anything, any addition over there. So, and this figure seems to remain constant over a considerable period of time, which is why we are seeing the operating leverage. To your thought, how much this number can see up rise or remain constant in the near and medium term, if you can put some light on that.
I will take that, Sunil. So you are right. Our model is unique, and we operate on a very stable kind of a fixed cost, which will not go up commensurately as the revenue goes up. So we have been able to drive operating leverage for the last many years, and we expect to continue doing the same. In this quarter also, the same is reflected in the expansion of EBITDA margin to 14.1% and even PAT margin coming closer to 10 now. So we do not give any guidance on our profit margin expansion, but yes, cost being largely stable except shipping cost, which will continue to go up in terms of volume growth. The other costs are more or less stable. So we'll see operating leverage going forward as well.
Okay. Two items out of that, other expenses I noticed. One is your doubtful debts, which arise, the provision or whatever write-off you paid arise from the budget pay, I presume. And the budget pay was around 39% of your sales in FY20, which translates to around almost 770 crores. So out of 770 crores, you had almost 19 crores of doubtful debt, which is around 2.5%. Do you see the same level of provisioning and of doubtful debts going in?
So the doubtful debts and advances for Q4, if you are talking about last year, also had there. Now, which we are as a strategy, we have been reducing it over a period of time. So going forward, these will only reflect the B2C numbers, which are very healthy. So if you look at our bad debts for US and UK, they are to the tune of about 1.2%. So you should see that only going forward.
So this number will come down. I mean,
this number will
lots of kind of doubtful debts we are having. this number will come down. Is it fair to assume?
In terms of percentage of revenue, it will remain same in terms of B2C to the level of 1.2%. It should remain at that level. The gross number will follow the revenue, so B2C revenue trend. So.
Okay. And the other thing was on the rent part. So I see almost your rent coming down from 16 crores to 8 crores. Anything over there missing out on it?
So in last year, it was the Ind AS restatement, which we also disclosed separately. So it was largely because of that. Otherwise, the rent have not come down to 50% in the last year. But that's a regrouping which was applicable last year because of the Ind AS restatement. From the current year levels, you will see these levels of rental impacted by renegotiations and also some contract-based increments as well.
Okay. Thank you. Thanks a lot.
Thank you.
Thank you. We take the next question from the line of Akash Singhania from Motilal Oswal Mutual Fund. Please go ahead.
Thank you, sir, for the opportunity again. My question is, sir, we already have a net cash of almost 250 crores and post our dividend policy, I feel we can almost double our cash flows in the next 1 year. So in terms of deployment of capital of our cash flows, are there any acquisition opportunities? And if there are acquisition opportunities, your views or perspective on the kind of capabilities, synergies and size of acquisition we would be interested or looking for. Thank you.
So thanks for the question, Akash. So we continue to build some cash within the group for any potential opportunity that may come our way. So far, we have not identified any specific opportunity, but we want to be prepared if something comes. But at this time, I cannot give you any visibility on that.
Okay. In terms of any areas in the front end, back end, in terms of business segments or capabilities or synergies you look to have from any target acquisition in any respect or any area, if you could share your perspective.
Yeah, if you will look, it will be mostly in the front end, whether it's digital or another TV e-com player, to expand our customer base.
Okay. Thank you. That's useful. Thank you once again.
Thanks, Akash.
Thank you. We take the next question from the line of Runjhun Jain from Nirmal Bang. Please go ahead.
Thank you for the opportunity and congratulations to the management. Sir, I'm sorry, but I would like to pester you a little bit more about the growth. We have done amazing growth in this quarter, and you're saying that it is for near to medium term it is likely to continue. Then I don't understand. And you're also saying that the essentials has come down, and this is the normal sales and normal products which has been selling. So why the management is not confident of probably upgrading the guidance or of continuity of this growth?
Thank you, Ranjan. Thanks for your question. The main reason is that we believe that the pandemic behavior of people staying indoors is helping online shopping and TV shopping. And we do not know when it will end. So we believe that once it ends, then the situation may again revert back to our 15 to 17% growth level. So that is why we are not giving that firm guidance. So, and also this is still very early in the current quarter. It's been only 1 month. We are seeing the elevated level. And if the behavior changes next week or next month, then the growth may not sustain. So pandemic is so uncertain, unprecedented. It's very difficult to replicate any past behavior into the new behavior. So we don't want to take that risk of giving a guidance and not meeting that.
Okay. Fair enough, sir. One more thing though. During this quarter, we have seen that the average selling price has come down, both for TV and web. Despite that, we have reported improvement in the gross margin. Just wanted to understand any reason specific why we are seeing the average selling price coming down, and what is driving the gross margin?
Yeah, so lower price point it doesn't mean that it has lower gross margin. In fact, our lower price point overall strategy has allowed us 60% kind of gross margin compared to other retailers who don't make these margins. So on TV and web, both we offered a lot of home products and essential products, and even the jewelry. High price points were not selling as much as lower price points. So overall, during this pandemic, a lot of lower price point products sold. And as we have said many times, that we offer customers what they need. We are very agile in offering the right product to the customer, and we would offer. So we depend on customer what they're pulling rather than we pushing.
Great, sir. So just last one bookkeeping question. Is there anything one time or one-off in the interest cost? Or that should be the run rate? Because that has come down quite drastically. I mean, I know this would be only the bank charges probably and all that because it's a debt-free company. But why it has been, as compared to the last quarter, or why it has been so down?
So there is no one-off in the interest cost. But what gets added to the interest cost is also the forex impact of the working capital loan which we have in India in USD. So it also depends a large part on that forex rate movement between Q and Q and so. So maybe in this quarter the impact of that forex loss on that working capital loan was not that much, which might be causing this number to be low. But overall also our utilization of the working capital limit have been little low when we look at year on year. So our net interest cost is also down.
Sir, is it possible for you to quantify the forex impact?
We can, maybe I can just have a look and give it to you by end of this call or separately.
No problem, sir. I'll call you separately and we can discuss it. Thank you. That's it from me. Thank you.
Thank you. We take the next question from the line of Ishit Naredi from Naredi Investment. Please go ahead.
Hello. Yeah. So, my question is, you have a manufacturing facility in China. So, is there any impact on manufacturing part or any kind of export problems you are facing between the China and the countries like US and UK?
So no, we're not facing any problem for our product categories from China in the current environment. Only when the China was in lockdown, at that time we couldn't ship anything from there. But now everything is normal.
Okay. And is there like any more different type of products you are planning to add in portfolio when UK or US?
So we continue to add. We continue to add more than 150 products every day. So as customers pull the product, we offer to them. And we have a lot of trend spotting people who are continuing to merchandise and look all over the world what is new, and then we offer. So it's an everyday offer, everyday phenomenon in our company.
Right. And are you planning to enter in any new geography, like in any new location or something?
Not immediately. Our longer-term goal is to get into Germany and Japan, but there's no immediate plan.
Okay. Thank you.
Sure.
Thank you. We take the next question from the line of Jason Soans from Monarch Network. Please go ahead.
So thanks for taking my question. You did mention earlier in the call that you want to increase your market share in the US from it's already increased from 1.5 to 3%, and you would want to, increase it further, and you see a long runway for growth. Just wanted to understand in the US as well as in the UK markets, what's your current market share and who is the dominant competitor out there?
Yeah, so the most dominant competitor is Curate Group. So they own about more than 90% of market size in both these geographies, US and UK.
US and UK. Okay, so they dominate with 90%. Okay, and so just one question. What I wanted to, you did mention that your low price point products are selling, and you see a lot of competition from the Curate Group as well. So just wanted to know, what do you think is the USP of our products or the USP of our value proposition?
Yeah, so we are mostly house brand company. So we develop our own brands and sell it under our brand, something like Zara. So we are more like Zara. And Curate Group is more like Macy's. They sell third-party brands. So they sell national brands of all different products. They have some of their house brands too. The majority of their sales comes from, say, Samsung of the world or Bose headphones and all different products. So that is the price point. The average price point they have is about double than our price point. So it's a different positioning in the marketplaces.
Oh, sure. Thanks. That's all from my side.
Sure.
Thank you. We take the next question from the line of Chintan Seth from Samiksha Capital. Please go ahead.
Thanks for the opportunity again, sir. One thing I like your comment on is the reversal of US pay support from the government. Will have any impact on our consumer purchases? Because from your inputs earlier that jewelry sales has been higher in the month of July. That is kind of reflecting that actual consumption demand has coming back from essentials to jewelry. So any impact of payroll reversal from the government have an impact on our consumer? How do you see that? And secondly, on the technology shift, like we saw in 15-16 with budget pays and easy returns, any new innovations coming in terms of service offering from the competitors or something like that, which might disrupt our market going forward?
So your first question, will the in US especially, the government has stopped giving the unemployment benefit to the consumers as of 31st of July. So
correct.
So far in the first 2 days, we are not seeing any impact on our business for that. But will there be impact? I do not know. There's so much unknown at this time. So to make a guess is, we shouldn't be making that guess. So second thing is, but in UK there is no such issue, so we don't expect anything there. Second thing is about any IT issues. So far, we have last 2-3 years, we continue to invest proactively in our customer offering, whether it is shipping promotions or IT infrastructure or team. We continue to make those investments, and we are pretty proactive forcing any future requirements. So we don't have any visibility of any issues at this time.
And competitive landscape remains steadier, and we continue to gain in this quarter as well, like what we saw past 3 years. Our market share has grown from 1.5% to 3%. Do you feel that we have gained the market?
We definitely have gained the market, and we are confident we'll continue to gain the market share in short to medium term.
Right. Sure. That's all from mine. Thank you.
Thanks, Chintan.
Thank you. We take the next question from the line of Tanvi Jain from AM Securities. Please go ahead. We've just lost the line for the current participant. We take the next question from the line of Kapil Banga, individual investor. Please go ahead.
Yeah, hi. Congratulations for the wonderful performance, and thanks for taking my questions. You had given guidance for 15 to 17% growth and did 25% plus. So you outdid your own guidance and walked the talk. So that's the hallmark for the good management. Congrats on that. So I have two questions, and these are on long-term strategy. First is, so we now have a very strong moat. We control the TV channel, we control the website and app through which we have direct access to millions of households in US and UK. Now, in the next leg of growth, is there a possibility to also use these robust platforms as marketplaces, at least initially on a limited basis, wherein third-party sellers can access these and sell products, maybe non-jewelry products, and these act like marketplaces? So this will actually give a higher revenue with limited capital deployment and will also lead to broader choices of products for our customers, making Vaibhav Global's platform more immersive and more indispensable for the customers, and also increase the wallet share. So that was my first question. Could you share your thoughts on this, please?
Thanks for your question, Kapil. It's a very interesting idea. So we see ourselves as a product development and very agile company. And with that, going into becoming a marketplace like Amazon or Walmart marketplace or eBay would be a big jump. So haven't really considered going that route yet. But in future, you never know where the future will take us. At this time, there is no visibility for this one.
Okay. On a pilot basis also, there's something you would want to try in the near term?
So this initiative, if at all anybody goes, has to go with full preparation and a lot of marketing budget to get the vendors and the customers. So that is a strategy that has to go in a major way, because you can't go pilot in this kind of new venture if you have to go that direction. That is my thought on that.
Yeah, that's right. So on the second question is that we started by selling jewelry, and went into women wear and all. So understandably, most of the products were initially, and they continue to be focused on women. Now we have successfully diversified into new products like hygiene products, health products, and jewelry products have now fallen to 60% of the revenues. Any plans to add a diversified customer-centric brands that will increase the utility of this platform to entire family and helps us get a larger wallet share of the family?
That's a very good question. So we are continuing to develop our in-house brands. For example, we have a Home Smart, a brand that both at US and UK developed internally. So within Home Smart, we have kitchen, we have living room, we have bedroom products like bed sheets or duvets or kitchen knives and kitchen utensils. So those kind of brands we are extending to different segments within home. For health, we have similarly we are developing another brand. And we have another higher end brand for home called Symphony Home that takes care of higher end, high quality products. And within say handbags or accessories, we have Sukriti, which is a leather handbag, hand painted collection. And in jewelry, we have other many different brands that goes within for men and women as well. So to your point, we are developing our house brands and making sure those brands resonate within those particular customer segments that can extend to entire family.
So I saw the men's trimmers also on the website a couple of days back. So that is also you. So men's centric products are also something that you are venturing into.
Correct. We've been doing that, but not to that level. So that ratio has slightly increased in recent times. But the trimmer was not under our own brand, but if it is something that we want to continue, then we'll bring it under our own brand in future.
Okay. I just had a feedback. This was a question that I had during the last con call also regarding the app downloads on the Play Store. So the app, just a follow-up observation on that. So, and you mentioned that you have hired a senior guy on the technology side, and it will take time. But app downloads have still not picked up very well, and some of the recent reviews on the app are not encouraging. So probably the client engagement and client satisfaction on the app can be improved further. That was just a feedback.
Very good observation, Kapil. We are continuing to work on our app both in US and UK, and the new app is under development, and hopefully we'll have that launched in current quarter.
Okay, that would be good. Thank you so much, and congratulations again for the wonderful performance.
Thank you, Kapil.
Thank you. Well, ladies and gentlemen, that was the last question for today. I would now like to hand the conference back to the management for closing comments.
Thank you, everybody, for your robust participation and for your continued support. So if you have any more questions, feel free to reach to Deepti Yadava or Shiv at CVR Capital. Thank you. So thank you very much.